Hi, everybody. Welcome to Step into the Future of Commercial Lending. My name is Paul Mackowick. I'm the general manager here at Evident, dedicated to the team that works on financial services for you. We're glad you've given us a portion of your day and trust you'll find it informative. We're indeed live, so please, if a question pops into your head, just leave it in the chat window and we'll address them in the QA session portion of the session a little later on. We are very fortunate to have Tim Scholten join us today. For those of you who haven't yet met Tim, he spent 33 years working in and improving the financial services industry, initially with First Michigan and then Huntington Bank, where he successfully revolutionized many aspects of their business before striking out on his own with his company Visible Progress. In his current venture, he coaches dozens of CEOs on strategy to create a winning customer-focused culture. In his spare time, he's also a best-selling author of Focus 5 Advantage, available on Amazon. The book is designed to provide you with clear steps, insights, and examples that will inspire you to your own degree of greatness. Welcome, Tim.
Thank you, Paul. Glad to be here.
Okay, here's a quick review of the topics we're going to talk about today and the key takeaways. Please feel free to post any questions again throughout our discussion for the QA box. We will address any question at the end of today's session. Okay, what we want to do is first discuss where commercial lending is today. Okay. Tim, your thoughts on where we are today?
Yeah, commercial lending's risen dramatically in the last 12 months. This chart from Trading Economics shows the rise in loans written from last January to last month. It shows increase of from 2.5 trillion to 2.85 trillion, or basically 0.35 or $350 billion. Mm-hmm. And this aligns with what I'm seeing banks that I work with. Commercial lending's been a great, strong source of growth for those clients. This growth happened also during the same time that PPP loans were being paid down or forgiven. So the real numbers are even stronger. And also, I've also seen data from the Fed that confirms this as well.
Well, that's great news. It seems the country is really shaking off the slump of the last 3 years. Did you see anything else of interest to our attendees?
Yeah, the cost to originate these loans has also increased, Paul. As we all witnessed over the last 12 months of growth, a large segment of the back office workforce left their jobs, creating competition for talent. To attract quality applicants, the pay for some of these positions has increased by more than 5% in hopes of attracting and retaining valuable employees. The number is represented by the largest portion of the orange part of the graph, the large orange piece. An interesting aspect of this chart is that the small purple strip just above the orange bar represents the investment being made in technology innovation over the same period. It's remained steady at 2% since 2012. Most notably, this provides proof of the statement made by Jonathan Korth, CEO of Ellie Mae, when he said, "Our industry solves the issues with human spackle." Clearly, this is still the case.
That makes sense. It really shows this is still a very strange economy we're living in. Further data on the bank pay topic from Crow surveys that pay increases at each performance level rose since 2021. Most notably, top performers saw an average of increase of 10%, up from 6% the previous year. Additionally, employees who met expectations of performance had an average pay increase of 8%, up from 3% in 2021. How is this cost distributed over the entire cost of the loan origination? Are there areas for improvement?
Oh, there sure are, Paul. These costs vary by institution, of course, but the numbers shown here generally feel like they're in the ballpark. It costs an average of just under $7,000 to book a loan, including all the amortized costs that you have from handling the loans that you didn't approve and or were withdrawn. So add in the sales and marketing costs and the costs of onboarding and funding, and the bank is averaging around $11,300 in cost for an average loan of about $600,000. The answer to your second question is yes, there's room for improvement.
Yeah, to put this in perspective, once you get past one $5-10 million in loans, due diligence costs go up, obviously. Thus, the two standard deviations of this range go from a low of around 9,000 to a high of around 19,000 for larger, more complex loans in industries such as hospitality, energy, and service forms. Also, as a side note, these costs drop by 10 to 50% for banks that employ business process automation, with an average drop of about 23%. So, given that that's the status of the industry today, does anyone recognize these underwriters? Okay, now it's a little joke, but there's a lot of manual processes still in our processes, even though we're talking hundreds and thousands of dollars and even millions of dollars. So, what I wanted to do is kind of go over what a typical commercial lending process is. To address our area of concern, let's take a look at the high level view of the typical loan origination process so we can better determine where the streamlining can best be applied. Will consist of the sales origination process across the top, the risk review, the committee review, and finally the implementation of the loan. Each institution might differ slightly, but this chart should still be recognizable by everyone on the webinar today. For today's discussion, I would ask you just to let's only highlight the areas we can modernize. So does this sound reasonable to all of you? Let me know if there's anything else you want to discuss in the chat, but feel free to drop a message. The areas now in green are the steps we can dramatically affect by applying AI, machine learning, and other technologies. Tim, can you give a brief description of what these advanced technologies can do for us?
Sure, Paul. Machine learning is technology used to learn about the insurance policy documents themselves and how best to extract the data from within those policies and then match that up against the underwriting criteria. As the name suggests, the technology increases in efficiency and accuracy and quality as it learns by collecting and handling more and more policies.
Mm-hmm.
Interesting point of this is that machine learning is a smart first step for most banks to take before jumping into AI. And the reason for that is the leap from machine learning to AI requires a significant amount of data to create added efficiencies like recommending policy coverage and requirements for the lenders. So actually AI can take that next step, but it requires lots and lots of information. And that then eliminates the human decision and data entry from the process. AI can go even further by incorporating insurance industry data that will show the probability of a claim for this property of this type in this region of the country, and thereby allow bankers to better manage their pricing and their risks. So AI can turn that data into increased profits and better risk management without intervention by humans.
Okay, let's take a look at the first area, sales origination and the benefits provided by the evident insurance verification as a service. What can we say about the first two steps here? To me, it looks like this is where a lot of the manual work is being done.
That's correct, Paul. The first two steps will show the most dramatic cost savings as they're intensely manual and require a great deal of insurance knowledge. Machine learning would be applied here to a great effect. A small or medium-sized bank could allocate 1 to 2 people to just ensuring adequate coverage is maintained for their commercial loans.
Okay, first step, gathering all of the insurance-related documents from the borrower or the broker. This step is surprisingly costly as members of the business team need to call or write to the parties to gather the needed documents. Sometimes several attempts will be needed, so automation is the best solution for this. Will be dramatic both in cost and time spent.
I would agree, Paul. Sometimes the communication isn't responded to, and the lender is going to have to decide how to best proceed. Sometimes it's a simple step of having the bank added as a lost payee, and that process can take up to weeks, just trying to connect with the right people and get them to take action.
Yeah, we've seen that quite a bit. Preparing for the credit application is our next step for automation. Mapping the collateral documents with the bank's requirements is a very tedious, time-consuming manual step, as we're looking at all free-form text like addresses, descriptions of properties, VIN numbers, and like. If the loan is going to be secured, it's imperative this step is as accurate as possible.
As more documents are run through the process, machine learning, the machine learns more about the documents, and the accuracy is increased by virtue of practice. If there's discrepancies between the submitted document and the requirements, then the borrower and the lender are automatically notified to provide further clarity or to make a correction.
Right. At this stage of the origination process, evident customers have experienced about an 85% reduction in administrative burden of verifying the insurance. We'll be reviewing a specific case study along these lines towards a little later on in the session today.
Yeah, the next step then is when a business team reviews the application and decides whether it's ready to submit the loan to the loan committee or to underwriters for approval. There's a lot of documentation here, and many facets beyond insurance take the team's time and attention. If the insurance coverage was a problem, it's hopefully been caught by now, and the automation has potentially corrected it even before the loan is sent for approval.
Well, if the members of the group see this as a problem or similar to what they're doing, I wouldn't mind hearing about it in the chat if you have a moment.
The benefit here to the bank is the time needed to process this application has been greatly reduced by eliminating waiting for humans to communicate. And that's always takes time, waiting for the human beings to connect, thereby increasing the velocity of the loans to closure. The automation's accelerated communications, collections of documents, and verified coverage to ensure that the bank's going to be protected in the case of collateral damage or loss, et cetera.
Yeah, it's interesting. As the banks meet their revenue goals, we all know that, and anyone on the relationship teams would know that if you hit your target this year, it's going to be increased next year. That's just the way life is in our business. So it's imperative to automate as much of the process as possible to speed everything through that is valid business to perform. When increasing the velocity, the loan approval represent a big advantage to your business teams. Again, let us know your thoughts in the chat. Moving on to our friends in risk, there will be rather frequent times when the insurance documents aren't really compliant with the lender's requirements, but the business team would like to have the risk team review to see if a concession is warranted. The risk team can take a look at the evident portal, which we can show you in a demo after this fact, at a clearly detailed discrepancy to make their assessment of the risk involved.
This actually represents the first time, Paul, where an actual human may need to interact with the insurance verification process. If the documents are compliant, then there shouldn't be any human touch needed. This way, the bank personnel only deal with exceptions. And this is the promise of true automation and leads to lower costs and increased loan approval velocity. This is also an area where banks may lack expertise. So, having people who really truly know how to read insurance documents and understand what they're looking at, to fully understand policies at the level needed is a challenge. Gaps in insurance expertise often create misses that go undiscovered until they're found by regulators during bank exams. Not a pleasant thing.
No, it's not. This is where the risk team can easily review the insurance coverage issues contained in the policy documents and make their recommendations. Of course, their main concern here is the reduction of relatively risk for their institution. Now we move on to the approval process for the loans presented by the business teams.
Correct. At this stage, Paul, the committee may look at the delta between the insurance policy and the requirements and decide how best to proceed based on the relationship with the borrower. So let's say there's a gap. Any kind of gap or discrepancy may not represent enough risk to warrant the added cost of a policy amendment or asking the borrower to spend more on coverage. And that sometimes can cause harm to the relationship or cause you to lose the deal.
Absolutely. Now, the loan has been approved by the loan committee. If everything's gone well, very little human interaction has been needed, and the closing package can now be put together. What's important to note here is that we have virtually eliminated the chance of loans being approved without compliant insurance coverage.
And the advantage here is that the loan made with coverage gaps at origination, because someone missed something, becomes an even greater challenge if policies lapse and the bank needs to apply LPI or force place some sort of coverage. Those of us familiar with force place and LPI processes know it's difficult and costly for both the borrower and the lender. Errors in placement cancellation, and payment are frequent in this space. Done manually, a single loan can take hours to resolve, and a good automation and automated communication can help minimize these costs for sure. The commercial lending example is a solid way to help your bank enter the ML, or machine learning and AI space. And so, just another quick note there, Paul. As you mentioned, eliminating that risk is a key thing. Catching it early, seeing it before it's a problem, is one of the key benefits I see of automation.
And that's a good point to make, to put an exclamation point behind, because saving a little bit of saving cost, saving time up front is important. It's useful, it's impactful, but really that relationship, taking that consideration whenever you're applying LPI or not, and applying LPI in a valid it, instance, is a really important relationship that the bank will have with the borrower. So I think it's important to point that out. I'm glad you did. Thank you.
Good.
Okay, I had promised the case study. So this is a lender. Actually, it's a bank association or cooperative that focuses in the southeast of the U.S. This organization needed to streamline their loan process for their more than 50 member banking centers. There was a strong mandate to normalize the loan processing across the institutions while still maintaining relationships with high-valued borrowers. Applying the evidence solution fueled by machine learning, these underwriting teams were able to achieve an 85% reduction in administrative burden of verifying insurance, along with the accompanying cost savings. They were also able to close loans faster due to automation, verifying that applications met coverage requirements and staff only needed to attend to the exceptions. So what's important here is these institutions also had a captive insurance provider provided by the association. Whenever that captive insurance had to apply LPI or forced place insurance, they're now very certain that whenever they do that, they're applying it to the coverage that was compliant at the time the loan was made, not having to go back and do it a second time. Very important part of the relationship that this organization is now able to apply to their membership. Okay, I'm going to go ahead and stop the slides now, and we're going to talk about some Q&A. Okay, I'm reading these. What part of the commercial loan origination process do you see as the most friction-plagued, Tim?
Paul, yeah, I think it's in the beginning. And it's in the beginning because you're working back between the borrower, you're working with the insurance company, and you're trying to connect and get all the needed information. You're trying to get loss payee coverage placed, exactly correct. And the timing of communication and the documents, it's a difficult thing.
Yeah.
It doesn't happen overnight. And so it usually requires hours of time to get everything in place needed. There are other points of friction with the borrower, but in general, that's if there's problems down the road.
Seems that's the lengthiest part of the process too, that initial information gathering and verification.
Yeah.
In your experience with other financial institutions, how does the lending experience from a commercial perspective affect their customer service culture, which you talk about and discuss and strategize with your customers? Does it differ from retail in any way?
Retail tends to be more, I would say, cookie cutter type of lending, and the policies are the same. They're obviously they have varying types of coverage on consumer, but they tend to be more cookie cutter kind of coverage.
Right.
So I think the whole commercial realm is much more complex, and it presents more challenges because in some cases you're trying to cover operational losses, not just collateral. So you're not just covering collateral in some cases. And so that makes the understanding of the policies so much more critical. If you'd have things like business interruption insurance as a requirement because you've got operating lines and so on. So those are the kinds of things that I think just the comparisons aren't the same. And uh, coverage varies so widely by the type
Right.
of commercial entity that it's difficult. It isn't cookie cutter like sort of automobile or consumer.
Yeah, if a bank's issuing a HELOC, or a mortgage, it's pretty much the same, from one borrower to
Correct.
the next, especially with the car loans, like you mentioned. I mean, when
Right.
you buy a car, you pretty much then get the insurance the next day.
Yeah, you got it.
Do you have insurance covering the price of the automobile? And that's pretty much it. So very uncomplicated, very, very easy to do.
Correct.
Um, Next one, Tim, of the banks you work with who want to streamline the origination process, like we're talking about here, but kind of unsure where to begin, what areas should they examine first and how would they go about that?
Well, I
Overall
know.
perspective.
Yeah, I know that some banks have done, on the consumer because consumer volume is so big. They've done sort of blanket policies on the consumer to take care of the majority of their consumer loans. So if they haven't done that, that would be one really simple step to take is blanket coverage on your consumer portfolio, and thereby only having to handle the larger exceptions. Um, some banks have used a similar approach with smaller commercial loans, again, depending on the size of the organization.
Okay.
But again, the variance there is so different. Every deal is different. So a great way to get started is just, let's make sure we understand the business really well and that our policies match our requirements. So what we talked about today with basic machine learning kinds of capability, I think it's a cost-effective way to get in to a more sophisticated level of automation, learn a bit about it, and and in the process, become more efficient and more, I'd say, regular. I don't want to say regulatory compliant, but just plug more risk holes that probably are being missed today. You mentioned as we were chatting, Paul, that there's some data out there, and I don't remember exactly where you said, but in the reviews, the regulatory gaps tend to be big. They're not often caught, but when they are and they look deeper, they tend to find a lot.
Right. Yeah. And then, what happens whenever there's this kind of discrepancy at audit time, it's not in the best,
Right.
it's not a good look for the bank.
No. And it's also not pleasant going back to a borrower and saying, "Hey, I need to ask you to increase your coverage
Exactly.
because we found out it's not compliant, or we are missing something and you got to spend some more money." Better to do that before you give them the money than after you've made the loan.
Exactly. And Tim mentioned studies. That preparing for this presentation, I did go through a lot of research, come up with some of the cost graphics you saw, and the loan business increasing, all sorts of things. If anyone would like what we call the source of these studies or something, just you could put something in the chat. You'd like me to send you something? I have all these documents that I have categorized and archived for you, so you can take a look at some of the points that we discussed here today.
Mhm.
Number four is, how would you make a business case for this type of solution?
Well, I think the business case is pretty straightforward, Paul. Is you got a lot of people time on the front end, and so that's your business case right there. And the whole machine learning approach to handling policies is about saving time and improving accuracy of the coverage. And I think you can accomplish both. And I think that is justifiable based on the hours saved. It's more than justifiable based on the hours saved. Uh, so I think that's the foundation for this business case.
Okay, I think a lot of it is the relationship with the borrower as well. I think that's a major contributor. Um, Question number five. Looks like it's one for me. It's evidence specific. Evident able to help with insurance tracking during servicing? Because this session has been focused on origination and what we do as far as insurance verification during this portion of the process. Excuse me. The answer is yes. Once the loan is made and it goes over to servicing, and there's an entry, the loan is in the core. Evident can continue on tracking that insurance as that loan progresses. And if there's a cancellation, or there's any kind of, or the policy is expiring for some reason, or there's a change in a policy, we can then start programmatically reaching out to the borrower or the broker to make sure that they, one, adhere to their commitment to have insurance or supply a new document to cover the requirements. So the answer to that question is yes, we do provide tracking for servicing. Just wasn't the focus of today's session. Okay. Question number 6. It might be for both of us, Tim. Is evident learning only from our documents, meaning the bank's documents that we work with, or is there learning from other institutions that evident can apply to our process to get us to value faster?
So I think, if you understand who Evident is, they do this for financial institutions. And one of the benefits of dealing with them in this type of solution is they're obviously handling millions of policies. So you have your machine learning has the benefit of all of those policies to learn, as opposed to starting from ground zero with your own solution.
Right.
So this is a cost-effective way of getting in, leveraging machine learning, and gaining the benefit of many people on one platform. That's the benefit of a cloud solution, right?
Exactly.
So I think this helps you get your processes up and operating quickly.
And just so you know, there is privacy and security from institution to institution. It's just that our service does learn from all the documents it's going to see, and we can apply that across the industry, across our customer base.
Mm-hmm.
So let's see if there's any other questions. That's it for questions. So I'd like to just go to one more slide here. And I'd like to thank everyone for joining us today. I know I've enjoyed it. Tim, thank you so much for your time. I know you have been doing well, so I really appreciate you getting through this with us. And if anyone would like to have a further discussion with me, or maybe set up a customized demonstration, be more than happy to do that. There's my name, there's my email address, and would love to talk to you further. So again, on behalf of Tim, myself, and all of Evident, I want to thank you for your time today.
Thanks, everyone.
Okay.